Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Okay, I hope everyone is doing well despite many challenges that we are facing. But hopefully everyone and with you and the family are doing well. Okay. Okay, so in last video I stopped at this topic for chapter 9. On the purchase commitments. Can everyone mute? So we'll continue for chapter 9. Okay, now let's look. This is still about the inventory valuation. Yeah? So we have a method of estimating inventory which is called as gross profit method. Why the sound is done? Is extra. Okay. Okay, sometimes the company need to quickly estimate how much is the ending inventory without actually doing the physical calculation. Yeah. Let's say for auditors, to identify what is the ending inventory that the company has. So they would use the gross profit method, to estimate the inventory. So it's basically a substitute measurement, to approximate inventory. It's not the real amount of inventory, but it gives an approximate, or estimated inventory amounts. So this method relies on certain assumptions, which are, first, the opening inventory plus purchases equal to total goods available for sale to be accounted for. Yeah, this the whole inventories that the company has. Okay, and then the goods or the inventories that are not sold, they must be on hand. So we assume anything that is not sold is to be on hand. Yeah, not to be stolen or disappear out of various reasons, but we assume it is on hand. Okay. And then the sales reduced to the cost amount deducted from the sum of the opening inventory plus purchases, it would equal to ending inventory. This is actually cost of goods sold. Okay, so the sales, what is the cost of goods sold of the sale? Yeah, and then we deduct from the sum of, or from the total of beginning inventory plus purchases, then it will give us the ending inventory. Let's see the example. Okay, let's say this company has a beginning inventory of 60,000, purchases of 200,000, both at cost, and then sales at selling price is 280,000. Okay, so we don't have the information what is the ending inventory, but the gross profit on selling price is 30%. Yeah. So from that information, we can identify the ending inventory. How to do that? Okay, so opening inventory, and then we plus the purchases, and then we get the goods available for sale. Yeah, so it's basically the whole inventory that we have to sell. Okay, and then we know the sales is 280,000, and then gross profit on sales is 30%. So it gives a gross profit of 84,000. Okay, so sales at cost, which is the sales at selling price minus the gross profit. It's basically cost of goods sold is 196,000. So cost of goods available for sale minus cost of goods sold, it will give us the ending inventory at cost. Okay? Follow me so far? Any questions so far? Okay, no question. Okay, what about if gross profit is not given? Okay, let's see if we compute, how do we compute a gross profit percentage? Assuming that, let's say the cost of that inventory is 15, it sells for 20, a gross profit is 5 euro, right? So the markup on retail price, which is on selling price, is 25% at retail. Okay? But markup on cost, so you have markup on retail price and markup on cost. Okay? Markup on cost, you will take the gross profit divide by the cost. Then you get the markup on cost. Yeah? Normally, the businesses would tell the customers their markup on retail rather than markup on cost. Why? Because markup on retail will show a lesser figure. Yeah, you see here 25% as compared to 33%. Okay, so it will be more appealing to the customers. Yeah, means the company doesn't really take a very high profit. Yeah, because you just mentioned the markup on the retail price. Yeah, but if you mention the markup on cost, it will show a higher amount. Yeah, so the customers might see that we take so much profit. Yeah. Okay, this is very much mathematical calculation. Okay. So if we know the gross profit on selling price, we can actually calculate how much is the markup on cost. Okay. And otherwise around. The markup on cost, if you know the markup, percentage markup on cost, we can identify the gross profit on selling price. How do we get gross profit? Is selling price minus cost, right? So from that component, you can maneuver, yeah, the calculation and say, you know, the selling price. We assume that the selling price is $1, yeah, and we know the wait a minute. We know the selling price and we know the cost, let's say, but we don't know the percentage of gross profit on selling price. So we can use the formulas to play around the information. Yeah. Okay, let's see the example. Okay, this company used the gross profit method to estimate inventory for monthly reporting purposes. So these are the information. Okay, let's say for A, compute the estimated inventory at May 31st, assuming that the gross profit is 25% of sales. So we detail out of all this information, starting from the beginning, inventory, and then plus purchases, and minus the purchase discount, plus the freight in. Freight in is transportation cost to bring in the inventory, okay? So that will give you a total of goods available for sale, yeah? And then we know the sales, which is at selling price. We minus the sales return, then we get the net sales, okay? And it gives us the gross profit on sales is 25%. So 25% times the net sale. So it will give us the cost of goods sold of 697,500. So by that, we can calculate the ending inventory at the end of the month by reducing the cost of goods available for sale to the cost of goods sold. Okay. Okay, let's say it doesn't give us the information gross profit on sales, but it gives us gross profit on costs. Okay, it says 25% on costs. And we do not know the cost, right? The cost of goods sold. Here, the 744,000 here is supposed to be unknown yet. Okay, so we need to convert that gross profit on cost to the gross profit on sales. Okay, so using the formula, so 25% over 100% plus 25%, then we can get the gross profit on sales, which is 20%. Then we can get the gross profit. By that, we can calculate the cost of goods sold of 744,000. So we can then identify the ending inventory of 74,000. Okay. Try again the exercise for you to understand well. Okay. Okay. Despite the usefulness of gross profit, yes. Any question? Any question just now? Someone wants to say something? No? No. Okay. Okay, gross profit method gives us the simplicity to calculate the ending inventory, right? Because we don't need to do the physical calculation of the inventory. Just if we have the information of gross profit rate on sales or the percentage of gross profit on sales, then we can identify the ending inventory. But such method has certain disadvantages, yeah? Because it only provides us an estimate of ending inventory, not an actual amount of inventory. Okay, and then it uses past percentages in calculation. Why past percentages? That gross profit on sales just now is based on previous year's percentage. Okay, so we use that to calculate the ending inventory of this year. Okay? So it may not reflect the actual gross profit for the current year. Okay? Okay, and then a blanket gross profit rate may not be representative. What does it mean by a blanket gross profit rate? Because it takes the lump sum of the gross profit, the whole amount of a gross profit. Let's say the company has many lines of products, yeah, which has a different rate of gross profit. So if we do this gross profit method, then we just take the whole amount. We don't consider each product's gross profit. Okay? We take the average gross profit for all products. Yeah? So that's what it means by a blanket gross profit. So it doesn't really give us, it doesn't really representing the information for each individual types of inventory. Okay. Okay, normally for financial reporting purposes, it is unacceptable because it only gives us the estimate. But the gross profit method is used for managerial purposes. Yeah? It's not for financial reporting purposes. It's used for managerial or for auditing purposes. Yeah? But for financial reporting purposes, still the company is required to provide the actual amount of inventory. either from the accounting system or by the actual physical calculation of the ending inventory. And even the IFRS requires the company to perform physical count of inventory to verify the inventory records. Yeah? Okay, now let's see the retail inventory method. Yeah. Okay, for the companies who doesn't have so many kinds of products, yeah, like automobile companies, airplane company like Airbus, Boeing, yeah, they don't have many lines of products. They just have specific lines of products, right? Normally they use specific identification method, right, to identify the cost for each product. Yeah? But imagine that situation for a retailer or a supermarket who has sometimes 100 types of products. Yeah? It's very difficult for them to adopt the specific identification method. Yeah? So normally for this kind of retailers like in our Banda Aceh context is Suzuya, or in other parts there are Carrefour, Giant, Jasco, yeah, Eon, yeah, mention it. There are many retailers, big retailing companies. So they cannot use that specific identification method. Yeah? So they normally use the retail inventory method. Yeah? So this method would need the retailers to maintain the record of total cost and retail value of the goods purchased. So they keep the information on the amount of a cost as well as the retail value. Retail value is the selling price, yeah? Selling price of the goods purchased, yeah? And then cost and the retail value of the goods available for sale, yeah? And the sales for the period. But they don't have the information of cost for each unit that is sold. Yeah, that's why we need this retail inventory method. Yeah, they have the cost of goods purchased. Okay, and then they have the cost of the total goods available for sale, but they don't have the cost of goods sold. Yeah, they don't maintain for each product. Yeah? So that's why they normally adopt the retail inventory method. Yeah? There are two approaches to use the retail inventory method. One is called conventional method or LCNRV, the lower of cost or net realizable value. And the other one is called as cost method. Okay, example. This information of a single department for the month of October for Fook Limited. And we prepare a schedule computing retail inventory using the conventional and cost method. Yeah? They have the beginning inventory and then purchases and then the freight in, purchase returns. Okay, markup. For retailer, they sometimes mark up the selling price. Okay, depends on the situation and the demand from the customers. Okay, let's say a retailer in clothing business. Okay, they buy that cloth for the price of 100,000 rupiah, let's say, yeah? And then they sell it for 200,000 rupiah. Let's say that cloth is very much trendy nowadays. Okay, so customers are highly purchasing that cloth. Okay, so seeing that condition, the company might increase the price of that cloth to 250,000. So that 50,000 is the markup. Okay, understand? So that's the additional markup during the period. Yeah. And then let's say, what is markup cancellations? After you mark up, you see that the demand is not that high anymore. And you reduce price back to, let's say, just now 250, now you make it 230. Okay? The original price is 200,000, and then you do the markup until 250,000, and then suddenly you reduce it to 230,000. So there is a reduction of 20,000 from the markup, right? So that one is markup cancellation. You cancel that 20,000 markup. Understood? Can I see your indication that you understand? Okay. Okay, and then markdown. Markdown is opposite of markup. Your original price is 200,000, and suddenly you see the demand for that product is not that good, so you reduce the price. So that one is markdown. Okay, let's say after you mark down from 200,000, you mark down until 180,000. Suddenly, oh, it has a good demand, so let's up again the price. So you make now 190,000. So that 10,000 from the original markdown to the increase of the price is called as markdown cancellation. Okay, so it's opposite from the markup. So far so good, yeah? Okay, using conventional method or the lower of cost or net realizable value, we only consider for the calculation of goods available for sale only the markup, not the markdown. Yeah? Markdown will be deducted after the goods available for sale. Okay, so take the beginning inventory plus purchases minus purchase return plus freight in, and then plus the markup net. Why they say net? They take the additional markup minus the markup cancellation. It gives you the net markup. See previously, the additional markups is 9,000. The markup cancellations is 2,000. So offsetting this will give us a net markup of 7,000. So we add that markup, then it gives us the cost of goods available for sale. Yeah. So the information about the cost of those products only available up until cost of goods available for sale. Yeah. And we don't have the information of ending inventory for the cost. Yeah. This is the retail perspective. Means based on the selling price. Okay, you got me? That's why you don't add the markup in the cost. This is the retail price, is the selling price. It only affects the selling price. Yeah. Okay, what do we do in retail inventory method for the conventional approach? We compare how much the cost of goods sold under the cost and retail. So 335,000 divided by 500,000, it gives us 67%. So means of this 500,000, actually the cost is 335,000. So later on, when we calculate the ending inventory, okay, we only have the information ending inventory for the retail prices, for the selling prices. We do not know what is the cost of ending inventory. So we take this percentage, we times with the ending inventory under retail. So it will give us the ending inventory at cost, okay, which is 64,588. Oke, boleh paham?
Boleh, Miss.
Okay, good. Okay, now moving to the second approach under retail inventory method, which is the cost method. Under the cost method, you consider all the markup and markdowns to get into the cost of goods available for sale. Yeah. Oh, sorry. So now that markdown is no longer under the goods available for sale, but it goes up. It has the same position as markup. Okay. So plus, plus, minus, and also you take the markdown net. Yeah, and then plus the markup. And it will give us a little bit different rate of cost to retail percentage. Now it's 67.49%. Yeah, just now it was 67%. Yeah. Because the goods available for sale is now has decreased, yeah, because we deduct the markdown. Yeah. So the ending inventory under cost method will be higher, which is 65,060. Okay, so that is retail inventory method. Yeah. Okay, special items relating to retail method. The freight cost we included just now, we add to the goods available for sale, purchase return, we minus, as well as purchase discount and allowances. Transfers in. Transfers in is the goods transferred from other division, yeah, from other subsidiary, from other unit to our company's unit, or maybe to the headquarters. So transfers in is considered like you will purchase from the outside organization, from the outside company. Okay, so it's included in the purchase amount. Okay, normal shortage we deducted just now from the goods available for sale. Abnormal shortage, and then employee discount. Sometimes the company gives discount to the employee for the goods purchased by the employee. So that one is also deducted accordingly. Okay. Okay, how is it different normal and abnormal shortages? Any idea? What's example of abnormal shortage? No? Normal shortage is very much like, you know, the usual estimated shortage. Yeah, you would estimate that a certain amount of inventories will be short of what we recorded in the system. Abnormal when the amount is high. Yeah, maybe there is a natural disaster that affect the storage of the company, that will result in what kerusakan, defective products. So it gives a abnormal amount of shortage. When you compare the actual amount at the storage and the one that you recorded, it gives a very high amount of difference. So that is normally regarded as abnormal shortages. Yeah, it could be due to various reasons. Maybe the breach, pencerobohan from other party that steal the company's inventories, or the natural disaster like flooding, tsunami event, or any other natural disaster. Okay. Okay, this is how portrayed for each item there. we put in the calculation of ending inventory. Yeah. So abnormal shortage needs to be included in the calculation of goods available for sale. We cannot regard that as an expense. Yeah? Here are regarded as expense. Employee discount and normal shortage are regarded as expenses. Yeah? But this one, because it is abnormal, it is rarely happen, so we include it in the calculation of goods available for sale. Okay. Okay. Why do we use the retail inventory method? Normally, it's to calculate the net income without the need to calculate the physical inventory. Yeah. We want to know the quick amount of net income. Yeah. And maybe the physical calculation of inventory has not been performed yet. So the company can just use the retail inventory method to identify the net income. Yeah? And also it gives us a control in determining the inventory shortage. Yeah? What is we can compare from the retail inventory method, and then we compare with the actual physical calculation of the inventory. Then we can identify the shortage, the difference between the two amounts. Also, the companies use that to regulate the quantities of merchandise on hand. Yeah, so they would see the pattern of goods available for sale, and then whether it is too much, yeah, it doesn't match with the demand for the products by comparing with the cost of goods sold and the ending inventory that they have. Yeah? So basically, they can coordinate the overall quantities of merchandise on hand. Yeah? And then it also gives the for insurance information. Yeah, normally the inventories are insured, means the company buy the insurance scheme for their inventories. Yeah? Okay, the retail inventory method, sometimes they use to compute inventories separately, yeah, for different kinds of products or for different types of departments. Yeah? Okay, now we move to a presentation of inventories. The IFRS basically requires the companies to disclose with regard to inventories, first, the accounting policies adopted in measuring inventories, yeah? Whether it is weighted average and FIFO. Why no LIFO? LIFO is not allowed under IFRS, okay? But LIFO is allowed in the United States, yeah? Why LIFO is not allowed? Still remember, I think I mentioned it before. Because? Anyone? Because it doesn't reflect the current economic condition. It doesn't reflect the actual cost flow of the products. Because you take the last in, first out. The last product is considered to be first out. Normally the price is increasing, right? So if we take the last product as a cost of product sold, it will show the higher cost of the product sold. Yeah, so it doesn't really gives the true information. The companies use LIFO normally to reduce their tax amount. Yeah, because it will increase the cost of goods sold. So it will reduce. If you increase the cost of goods sold, what will be reduced in the income statement? It will reduce the net income. It will reduce the gross profit as well as the net income. So by that, you will pay the tax lesser. than what is supposed to be. Yeah. So it's normally manipulated for that purpose, the use of LIFO. And then what else to be disclosed is the total carrying amount of inventories and carrying amount in classifications. Yeah? Let's say if it is a manufacturing companies, then they need to differentiate what is the amount of inventory for each category of raw materials, work in progress, and finished goods. Yeah? And then carrying amount of inventory is carried at fair value less cost to sell. This is the LNC RV. Yeah? Okay, amount of inventory is recognized as an expense when we identify there is a shortage. So normally we recognize that shortage as an expense. We write off that inventories. Yeah? Okay, amount of any write down of inventories recognized as an expense. Let's say the products are defective, yeah, rusak, then we need to write down the inventory. Again, we include it in the expense. Yeah? Or because the economic condition, okay, let's say the pandemic, yeah, because of the pandemic, the demand for certain products are very low. Let's say for textiles, yeah, people are not buying the textiles during the pandemic, right? So the company may decide to write down the inventories for the textile product. Yeah, and let's say after the pandemic, the economy is improving, then they want to again write up the amount of that product. So they need to identify what is the amount of reversal of write down, what was the amount of write down, etc. Yeah. So basically, it's a full disclosure of the inventory. Yeah? And the company also need to explain what caused the reversal of write down of inventory. Just now I say, let's say after pandemic, the value of the product are believed to be increasing, okay, due to the increasing demand. So the company needs to explain that condition in their annual report or the notes to the financial statement. Yeah? And any other amount of inventory pledged as security means the company may use their inventory to borrow the money from the bank, and they put it as a pledge or as a, what do you call that one? Guarantee, yeah? As a security, yeah? For the bank. So that one also needs to be disclosed, yeah? Because that's considered as liability. Yeah. So the company shouldn't only disclose the inventories, but actually they use the inventory for the purpose of getting the loan from the bank or any other party. So it needs to be explained in the notes to the financial statements. Yeah? This one you will be learning, or you are learning through the course of analysis of financial statements. But basically from the inventory, we can analyze in terms of inventory turnover. Yeah. How quickly the company can sell the inventory during the period. Yeah. That the information of inventory turnover. Yeah. The higher, the better. Yeah, means the company can quickly replenish or replace their inventories for the purpose of selling. It doesn't start at the company. Okay, and then average days to sell the inventory. Okay. How long the company takes to sell the inventory? The higher the better, or the lower the better? For average days to sell the inventory. Any answer? The higher, the better, or the lower, the better? Just now inventory turnover, the higher, the better, right? Average days to sell, the lower, the better. Yeah, means it can be sold very quickly. Okay. Comparing IFRS and US GAAP mostly are the same, except what I mentioned just now, that IFRS prohibits, doesn't allow the use of LIFO, but the US generally accepted accounting principles allows the use of LIFO. Okay, any question for this topic? It's quite a lot, I believe, for you to learn and digest. But I hope you can at least understand the overall concept. Yeah? Sometimes the technical things you need to go deeply into each topic of it. Okay, can we move to the next topic, or any other thing that you want to inform me, to let me know? Or you want to complain, Miss, it's too much? Is it too much? Okay, now where is it? If there is no any question, we move to the next chapter. Okay, because we have another 2 chapters to finish off. Yeah. Okay, again, if you follow the structure of the learning topics, we started with the overall financial reporting concept, right? And then you go through to each element of financial statement, starting from the statement of financial position, which was cash, and then receivables, and then inventories. Okay, so that was the current assets. Now we are moving into the long-term asset or non-current assets. Yeah, which among others, the main non-current assets are property, plant, and equipment. Yeah. Measuring the property, plant, and equipment is not as simple as it looks in the real business conditions. Yeah, it's a very complex issues for the businesses to identify what is the actual value of their non-current assets for property, plant, and equipment. Yeah. And also the decision to purchase or to have a new property, plant, and equipment is also a complex decision for the businesses. Yeah? They need to consider various factors. Yeah? If they spend too much on the non-current assets like property, plant, and equipment, their capital will be very much stuck in the non-current assets. Okay, if they spend too little, means they are not expanding their businesses well. Okay, so they need to find the best appropriate value or investment into property, plant, and equipment. It depends on each company. Yeah, it depends on the operation of the company, the need of the operation, and then the amount of financing that they have. Yeah, so that will influence in their decision to have property, plant, and equipment, additional property, plant, and equipment. Yeah. Okay, sometimes this PPE is normally shortened into PPE. They are of durable nature. What is durable? Durable is opposite of perishable. Perishable like food items. Yeah? Durable is something that can stay in longer period. Yeah? Perishable is easily perish. It's easily destroyed, like food, drinks, etc. Okay, so PPE are assets of a durable nature. Sometimes they are called plant assets, and sometimes fixed assets, or sometimes long-term asset or non-current assets. Yeah. What's the criteria to include the asset into PPE? First, it must be used in operations. Okay, for example, the land is used for the operation. It's not used for investment purposes. It's not used for resale purposes. Do you understand what I mean? The company doesn't buy the land for the purpose of reselling it, but it buys the land for the purpose of the operation itself. Or it buys the building for the purpose of using it for their operation, not for the objective of selling it again after sometimes. Yeah. So this is the first requirement for the asset to be included in the PPE. Yeah. It must be used for operation. And then it must be long-term in nature and usually depreciated. Yeah. Because it is durable, so it is long-term in nature. It shouldn't be for short-term. And then the company must possess the physical substance. What does it mean? It must obvious, yeah? You can see that substance, the physical substance of that asset, yeah? So only that can be included as property, plant, and equipment, yeah? Sometimes the company has the ownership of the asset, but it doesn't have the physical substance. Yeah. Let's say Abi has a company, it buys a building, but it doesn't really utilize that building. The building is being used by the brother of Abi. So you don't really have the physical substance of that building. Yeah. The physical substance is being utilized by other party. So that one means you don't possess the physical substance. Okay. Or the building is leased out to other companies. Even though on the paper you own that building, but the building is being leased, disewakan ke perusahaan lain, so it's being used by other company. That one shouldn't be recognized as our PPE. Yeah, later on, I think you have identified the concept of substance over form. So in accounting, IFRS, substance is more important than the form. The form is the legal ownership. So whoever use the physical substance, he has the right to claim, to report it on its financial statement. Okay? This is what it meant by possess physical substance. Okay, PPE is recognized or measured using the historical cost. Yeah? Historical cost measures the cash or cash equivalent price of obtaining the asset. So the whole process of obtaining the asset and bringing the asset to the location and then making it in operation, the whole cost will be considered as the cost of the asset. So it's not only the price of that asset. Let's say we buy a building for 1 trillion rupiah, but we need to pay the tax on that building, let's say 500 million, and then we need we need further clearing up the job, major renovation to the building before we can use that building. So whole cost, all those costs will be included as a cost of the building. So it's not only the purchase price of the building. Okay? So basically the cost will include the purchase price, which include the duties, tax, minus the discount and rebates, etc. And then costs attributable to bringing the asset to the location, and condition necessary for it to be used in a manner intended by the company. For number 2, let's say the company purchased an equipment, machinery, and then it needs somebody to install that equipment in the company. So that installment cost is also considered as the cost of that machinery. So it's not only the purchase price. And then we need the cost to train the people to use that machinery. Again, that cost also will be part of the cost of the machinery. So that's why it says for it to be used in a manner intended. So all the costs that are necessary before we can really use that asset. That's what it means in this concept. Okay, I hope you understand. Okay, the companies value the PPE can use either the cost method or fair value revaluation method, the subsequent period. And in the initial time, you use the historical cost, because historical costs also reflect the fair value cost. But subsequent periods, the company may choose to use the cost method or fair value method. Okay, if it is, let's go into detail, let's say for the land. Cost of the land includes the purchase price and then closing costs, let's say title to the land, and we pay to the attorney, pengacara, to arrange the arrangement of the title of the land, pengurusan pindah milik, any other costs, legal costs, to the purchase transaction. And then cost of grading, filling, draining, and clearing. Okay. Normally the land when the company purchase is not ready to be used. They need to be graded to the, what's they call in Indonesia? You put more soils into the land, upgrade it, and then filling, draining, clearing. Maybe there is a old building there. There is initial structures that need to be cleared, or the look of the land is very like forest, so the company needs to do the clearing job there. So those costs also will be part of the cost of the land. And then any assumptions of mortgage, encumbrances of the property means if the land has been used as a mortgage previously, maybe the company needs to settle that issue, the mortgage issue. So that one also will be part of the cost of the land. Additional land improvements that have an indefinite life. For example, maybe the company built the parking that will be used permanently. So that one also will be considered as additional land cost. Oh, not the parking. Parking will be a separately building, right? Maybe this is like a pavement, jalan laluan, it is permanent in nature. So it will be considered as a cost of the land. Okay, any improvement with limited lives, such as walls, fences, pagar, parking lots, it will be recorded as a land improvement and depreciated. So we have land improvement. So it is recorded differently, separately. Okay, let's say the company purchased the land for the purpose of reselling. It does not plan to use it, so that one will be included as investment rather than PPE or fixed asset. Okay, so it's a different category. Okay, land held by a real estate company for resale instead be classified as inventory. Why? For the real estate business, they buy the land, they are selling and purchasing the land. So land is basically their merchandise. That's why it's included in inventory. It's not recorded as land or it's not recorded as investment, but as a merchandise inventory itself. Yeah, because the nature of the company's operation is to purchase and sell the land or the buildings. Yeah. Okay, any question from the cost of the land? No? Okay, we move to the cost of the building. Cost of the building. Any costs related directly to the acquisition or construction of the building, which include the materials, labors, overhead costs incurred during construction, if it is self-constructed building, professional fees and building permits. Yeah? And then all costs incurred from excavation to completion will be included as part of the building cost. Yeah? Now, cost of equipment. They include the purchase price, freight handling charges, insurance on equipment while in transit, cost of special foundations. Certain equipment, sometimes when we want to use it in our company, it needs a special foundation in it. So the cost of that special foundation also will be included in the cost of equipment. And then assembling and installation costs, cost of conducting trial runs, like I said about machinery just now. So installation costs, we need someone to install, and then we need them also to run the trial, the first operationalizing the machinery or equipment, okay? So that will be also included as part of cost of equipment. Okay, let's try this. The expenditures and receipts below are related to land improvement and building acquired for use in a business enterprise. Determine how the following should be classified. Money borrowed to pay building contractor. What do you think is it? Abi? What do you think is it? How do we recognize that cost? Money borrowed to pay building contractor.
Money borrowed.
Masuk ke mana dia? Dicatat sebagai apa?
Account payable is.
Payable or not payable? Not payable, right?
Not payable. Not payable.
Because it's signed a note. Yeah. Then payment for construction from not proceeds. Dara. Payment for construction from not proceeds. Dara Salsabila, where are you?
Yes, Miss.
Yeah. Okay. What do you think is it?
Buildings.
Building. I hope you don't check the slide.
Buildings.
Yes. So because we say any construction cost, right? We just want to confuse you from not proceeds. Yeah. This one just to give you information where the source of the payment. Okay. So the construction cost basically will be part of the building. Yeah. Cost of landfill and clearing. Anyone? Arum? Landfill and clearing. Biaya tambak ya. Tambak dan pembersihan tanah.
I don't know, Miss.
You see, it's a land. So anything related to make useful of the land, it will go to the cost of the land. So we will capitalize the cost to the land account. Yeah. Okay, delinquent real estate taxes on property assumed by purchaser. Anyone wants to try?
Land.
Okay, who's that?
Me.
Mira ya?
Dara.
Oh, Dara. Okay, Dara. Sorry. Yeah, Dara, what do you think?
Land, Miss.
Land. This one on property.
Yeah.
Why? Why land? What does it mean by delinquent? This is not a very often word even for me. What does it mean, delinquent? Delinquent. Dara?
In finance.
Overdue, eh? Overdue asset taxes on property assumed by
Not paying.
yeah, it
Not paying.
was not paid by the previous owner, so the purchaser needs to pay that on property. Okay, I was thinking maybe the company buys the land, yeah? Then there is a tax that has not been paid by the previous owner. Yeah? So the company or the buyer need to pay that taxes. Yeah? Okay, so it will be included in the land. Okay, next, premium on 6-month insurance policy during construction. Who next? Nufus?
Building, Miss.
Okay. Why building? Because any costs incurred during the construction of the building, it will be part of the building cost. Yeah. Okay, quickly. Izzatul Ula. F. Refund of 1-month insurance premium because construction completed early. Izzatul Ula. Is she here? Are you here? Oh, Ramatuli? Rama?
Yes,
Yes.
I think it's building.
Building?
Yeah.
Refund of 1-month insurance premium.
Or tax refund of 1 month.
Construction completed early. So previously, when we paid insurance, we have included the cost of insurance to the buildings. Okay, and now the construction of the building has completed early. So we are given back the 1-month insurance premium. So we need to deduct the previously recorded insurance amount in the building. That's why deduct the building or credit the building account. Okay, Rama?
Yeah.
If you pay insurance during the construction, yes, it must add into the buildings. Okay, next, architect's fee on building. Quickly, anyone?
Building.
Building, okay, yes, building. Cost of real estate purchase as a plant site. Land 200,000, building 50,000. So it will go into?
Is it land and building?
Yes, land and building.
Yeah.
Oh, we included land only. Oh, I see. Sorry, Rama. We have to be careful because it says as a plant site. Yeah. So that building will not be used as our factory, but the whole land will become the plant site. Maybe the company will build a separate building later on. Yeah, a plant site. It's only the site. So we include that one all as a cost of the land. Yeah. So sometimes the cost of demolishing or destroying the existing building on the land is included in the land cost because we need the land. We want to use the land, not the building. So we consider that as a land cost. Okay. And then commission fee paid to the real estate agency is considered as land. Cost of raising and removing building. I just said that. So that one will be considered as a cost of Tatula.
Is it land, Miss?
Yes, land. Okay. Installation of fences around property. Remember, installation of fences is not really permanent structure. So we consider that as a land improvement. Right. It's a land improvement. Yeah? It's not really an integral to the land. Okay, proceeds from residual value of demolished building. Do you think how we record this, Belfa? Belfa?
Yes, Miss.
Yes. Proceeds from residual value of demolished building. How do we record that?
Is it land, Miss?
Hmm? Yes.
Land.
Land, but do we add or do we reduce from the land? Because it's proceeds, yeah? It's not the cost. So we will reduce it from the value of the land because we get the proceed. Yeah? What's the example of proceed from residual value of demolished building? Let's say the company destroyed the building, but some components of the building can be sold. Yeah, some of the structure of the building it can be resold. Yeah, maybe the roofs. I do not know the woods. Yeah, so that will give the proceeds to the company. It will give the money, so it will reduce the cost of the land. Yeah. Interest paid during construction on money borrowed for construction. It will add the cost of buildings. Okay. Cost of parking lots and driveways. That one will be like fences. It is land improvements. Yeah. Cost of trees and shrubbery planted is permanent in nature, it says, so it include in land. Yeah. Let's say the company builds a landscape which not permanent in nature. That one will be included in land improvement. Yeah, landscape normally it will be changed after 2 years, right? So it cannot be included in the land cost. But if it is permanent in nature, then will be included in the land cost. Yeah. Excavation cost for new building will be included in the building cost. Okay. Can we proceed a little bit or you want to stop there? Okay, just a little bit. What does it mean by self-contracted assets? Okay, if it is a purchase asset, it will be a bit easier to identify the cost of that asset. Okay, but if it is a self-constructed asset, it will be a little bit complex to identify what cost to include in the cost of the asset. Yeah. But basically, the main cost included in the self-constructed assets like building are the materials and direct labors. Meanwhile, the overhead can be handled in two ways. Yeah. Some argue that we shouldn't assign any fixed overhead to the cost of self-constructed assets. Yeah. Just expense it, yeah, any overhead cost. Whereby another school of thought argue that certain portion of overhead needs to be included in the cost of the asset. Yeah. Okay, mostly the companies would use the second method because the idea, as we discussed just now in the beginning, is anything related to the process of getting that asset ready for use will be included as part as the cost of that asset. That's why we still need to include certain portion of overhead that directly related to construction process. Yeah. Okay, another issue is interest cost during construction. Yeah. So there are different opinions as well. Yeah, whether to include or not to include the interest cost during construction. Yeah. One opinion is to capitalize no interest during construction. Yeah. They argue that the interest just to be expensed as financing costs. It shouldn't be capitalized as part of assets. Yeah. Another extreme opinion is to capitalize all the interests incurred during the construction. Yeah. Meanwhile, the majority, including the IFRS, is to use the moderate approach, which is capitalize only the actual interest cost incurred during the construction. Yeah, the actual cost. What does it mean by capitalize all interest costs? It also needs to calculate what is the interest on equity financing, not only the debt financing. Yeah. But actually that's not the actual interest cost, right? For the equity financing. For the debt financing, yes. The company is paying interest to for their debt, right? So that's why the IFRS requires only capitalizing actual interest costs during the construction. Okay. Okay. This will be involving a quite, what I say, it's not difficult, but it's step-by-step calculation of how we can identify the actual interest cost. I would postpone it to the next meeting. Okay. So basically, the capitalization considers the three items. What are the qualifying assets and how long the capitalizing period, and what is the amount of capitalization. So we will do the step-by-step calculation next week, inshallah. I hope you read and try first by yourself before you attend the class next week. And I will give the exercise on e-learning. Yeah, last week you were lucky, I didn't give you exercise. I was overwhelmed with other tasks, my personal tasks and the lectures tasks as well. So I forgot already. Okay. So check your e-learning later on. Okay. I will put the assignment. Okay. Any questions so far? No? Okay. If there is no question, let's end the class with reciting Surah Walas and Tasbih Kifah. Bismillah. Okay, I apologize for any mistake and shortcomings. I wish you all the best. Study hard, stay safe. See you. Assalamualaikum warahmatullahi wabarakatuh.